Just minutes ago, John Chambers of Standard & Poor's told us what would happen if Congress fails to raise the debt ceiling and the Treasury Department defaults on some of its obligations. America's credit would be downgraded from AAA to D. Jerome Fons is Executive Vice President at Kroll Bond Ratings Agency, a competitor to S&P, and he specializes in credit risk and rating agency issues. He's with us by phone this morning. Jerry, we really appreciate your taking out some time to talk to us this early. Tell me what you think of what John Chambers just said, that the U.S. sovereign credit, we're talking about the world's benchmark, would be downgraded to D in the event we default on the debt.
Good morning, Eric. Thank you. That's interesting. I think, first of all, this is someplace we've been before. I'm sure you know, 15 years ago, the rating agencies faced the same issue when the debt ceiling issue came up and actually was prolonged for many months, and they grappled with the same problem. The fact that S&P is considering a D really, to my mind, reflects their notion of what their ratings mean, and they are rating to timely interest, and they do not take into account any notion of severity of loss in their ratings.
Does it matter at the end of the day? This is the key question, I suppose. Does it matter to the consumers of these credit ratings? We're talking about the world's financial markets, whether it's D or whether it's AA, as Moody said it would be. Anything less than AAA is catastrophe, Armageddon. I don't know. I don't want to put words in your mouth.
Well,
but once you're not AAA, does it matter what you are anymore?
Well, first of all, there are very few AAA entities, rated entities in the world today. AAA is the original notion is gilt edge, that there is supposed to be little, if any, potential for risk or default here. The problem here is that there are many obligations that the Treasury has outstanding that they will not default on, at least for the next 10 years or more. So holders of those bonds will not really be served well by knowing that the government is rated D, when in fact their bonds are money good, at least for the near term.
Jerry, in Europe, the bond market doesn't seem to care anymore what Moody's and S&P say. The yields on, Irish debt, Portuguese debt, Spanish debt don't correspond to the ratings any longer, but the United States seems to be the last place where the rating agencies have the final word. Remember, treasuries are still, 10-year treasuries are still trading just north of only 3%. Why is that the case?
Well, I mean, the bond markets, the capital markets need a reference instrument, and they are still, U.S. treasuries are still considered the, quote, risk-free asset here. So they need a benchmark, they need something to trade off of, and they are still a safe haven. People still are attracted to them in an area, in this environment of high risk.
Should they be considered risk-free? Clearly, when we're talking about the debt ceiling and any default on Treasury bills maturing on August the 4th, we're talking about a very near-term situation. But at S&P and Moody's and any number of other people have been reminding us, probably even you over the last several months and possibly even years, the U.S. is heading to a position where the amount of debt it has to service is going to be unsustainable, especially if Treasury yields begin to rise. In your opinion, should this country still be rated AAA?
If the Treasury, if the policymakers in Washington do not address the fundamental problems in the country, we are definitely on a trajectory where the country is not going to be AAA. So I think people recognize that. They have the wherewithal to fix that. The question is, do they have the political will to do so? So, we could be AAA, but if things aren't rectified, we will not be.
Jerry, we have never come to the point where the rating agencies, whether it's S&P, Moody's, or possibly Fitch, or maybe even Kroll, have had to make good on this threat. Do you believe that they will? Do you believe that if we fail to raise the debt ceiling and the United States government defaults on some of its obligations, S&P will downgrade America to a D, and Moody's will downgrade it to AA or perhaps even lower?
I think the near-term likelihood is, first of all, S&P already has them on negative outlook. Moody's will probably put them on negative outlook as well. We'll sit there for a bit, and if things still are, in chaos there, they would possibly move them to AA, and I think that's where they would probably sit, high AA.
All right, Jerry, great to have you here in the Inside Track. Jerome Fons, Executive Vice President at the Kroll Bond Rating Agency.